All right. Again, hello, everybody. My name is Tony Warfield. I'm super excited about the opportunity to be able to share this information with you all today. Normally, we'd be using a poll, but we're going to be using a PowerPoint presentation today. As we continue forward, you're going to be hearing people jump in and jump out. Make sure that you feel free to welcome everybody in. This is intended to be an interactive discussion, so we're going to be talking about the correct answers as well as why the incorrect answers are incorrect. So without further ado, I'm gonna go ahead and share my screen and let's see if we can, again, Cassandra, let me know if you can see the screen.
Yes.
Outstanding. So, all right. So if you got any background noise or anything going on, go ahead and mute yourself out. If you want to chime in on any of the answers, feel free to chime in and let's go ahead and get started. All right. So question number one, be prepared. Right now, you'll see that I got those subliminal messages sitting off to the side right there. Median wealth of Black American and families, Black and Latino families could hit zero by the middle of the century. But that's not the question. But I definitely want you to take that with you as you move on. What is the most popular type of life insurance owned in urban communities, and which types can offer a legacy for your family? Who wants to volunteer that answer? A, final expense burial policies, term, whole, universal, Gerber plans, term, whole, or universal, pre-need, accidental death, or Gerber, I forgot to put the third one in there, and then accidental death, final expense burial policy, Gerber, or pre-need. Which one, A, B, C, or D? Which one do you guys think? Who's going to hum the Jeopardy music?
We got a D, we got an A.
I got Jeopardy music. If you want to make me a co-host, I'll get you some music.
Okay.
I'll hook you up. Hold on, Tracy.
Don't hook me up. All right, good deal. I see Miss Baylark in the house. Welcome, Miss Baylark, Field Director. Thank you for joining us. All right, put your pens down. Y'all ready?
How much time do we have for the quiz?
I don't know. This is, I'm just going to talk about each question in detail. The quiz I was just going to do for 5 minutes, and we're just going to talk about each question. But since the quiz didn't work, we're just going to talk about each question one at a time, right? So let's go ahead. What is the most popular type of life insurance owned in urban communities, and which types can offer a legacy for your family? The actual most popular type in urban communities are final expense policies. Final expense policies are usually offered to Black and brown families, especially later on in their lives. And you often see final expense policies being marketed to Black and brown communities, mainly because they're small face amounts, anywhere from $5,000 to $25,000, but the premiums are usually pretty hefty, but they don't offer any legacy protection, right? So the second part of that question is, which types offer a legacy for your family? In order for you to have a financial legacy for your family, you have to have some money remaining in that life policy to be able, after the expenses for your funeral. So a Gerber plan won't do that. A pre-need plan won't do that. And an accidental death definitely won't do that. So the answer would be A, final expensive term, even though a term terms out after, 5, 10, 20, or 30 to 35 years, if you expire within the term period, the amount of money for the face amount can cover the cost of insurance, and the remaining balance can protect your family, your house, your assets, making sure your kids go to college and whatnot. Whole life, that's permanent insurance, as well as universal life, whatever type of universal life that you have. So the answer to that is A. Does everybody got that? I like the deer in the headlights look. Okay, here we go. I couldn't get that second question in there for you, Cassandra, so we're going to work on this. So get on track, right? How do you determine the type of insurance you need?
The dime method.
How do you determine the type of insurance you need? Using the answers that I'm showing right. The dime method talks about how much you need. How do you determine the type you need?
C, consult a qualified life insurance agent.
I think you're right. Obviously, it's not rock paper scissors, but a lot of people go to the reason why I put B in there and D. A lot of people go to family because they know family members might have a specific type of life insurance policy. But if you go to family, right, the policy that they might have might not be the policy that's for you. It might not give you the protection that you and your family need, right? So family is not always the best place to go, and you can look it up on the internet, but you're only going to find what you know, right? So if you're only looking for what you know, you still might not find exactly what you need. So it's better for you to contact a qualified life insurance agent so they can be able to take you through the process to make sure you get the right coverage for you and your family. And then you have number 3. So think about family. What method can you use, Pastor Josie, to determine how much life insurance you need? Somebody was reading ahead. That's what it was.
No, the dime method. But I wasn't even on that sharing screen, unfortunately. That's why I couldn't know that.
Oh, that's okay.
Choices.
It is the dime method. Okay. So I have my resident guru on the line. Miss Baylark, let me know when you want to chime in. Obviously, it's not the KISS, keep it simple, silly. The 5P is proper planning prevents poor performance, fear, false evidence appearing real. Y'all might have heard that before. And the last one is my own. Don't trip. Taxes, risk, inflation, and procrastination, which is a huge problem in our community, which is why we end up having to pay so much additional monies for our life insurance when we could have got the life insurance while we were younger, right? So please slow me down if you got any comments, because you know I like this stuff. A high risk tolerance needed. So let me see, who am I going to pick on? Miss Annette, how you doing? You're looking awful.
I'm doing good, thank you.
You're looking awful comfortable over there. Could you do me a huge favor and read this question, please?
Read this question that's posted.
Yes, ma'am.
Or the next question.
This one right here.
So what method can you use? Oh, a high risk tolerance needed?
Yes, that's the one.
If you have 100,000 saved in each of your portfolio's account and the market dropped 50% on Monday and went up 50% on Tuesday, which 2 account balance are correct? Dropped to 50. 7,000.
75,000.
They both drop 50 and they go back up 50. I'll just take a guess. I don't know. C.
But it's 2 answers. So it's C. So you said C, and what's your other answer?
C or A?
C or A? Okay. Anybody else?
D.
C. You got C and D. Okay, I got C and D and C and A. Anybody else?
I said D.
Okay, so we got a couple of D's. So right now, our resident field director is on the line right now. And, she's one of the most, one of the greatest people in census right now, one of the nicest people I know. And I always like to defer to her whenever we have a conflict in an answer. Miss Baylark, are you on the line right now?
Yes, I am. Good evening, everyone.
Yes. So there seems to be a conflict in this answer, Miss Baylark. We got some people saying C and A, and some people saying C and D. So the question is, if you have 100,000 saved in each of your portfolio accounts and the market drops 50% on Monday and went up 50% on Tuesday, which 2 account balances are correct? So A says 401k drops to $50,000, and on Tuesday it goes back up to $100,000. B says stock drops to $50,000, and on Tuesday it goes back up to $100,000. C says the IUL stays at $100,000 and then goes up to $150,000 on Tuesday. And then D says the 401k drops to 50,000 and goes up to 75,000 on Tuesday. So there's two answers. Which two answers are correct?
C and D.
I'm gonna go with C and D. Why, Miss Baylard?
Well, the IUL on C, we have something that's called an index strategy with our instrument, our financial instruments. And what that is that it gives you an opportunity to participate in the market without participating in the loss. The reason why you can do that is because you're at a cap rate, your rate of return. An example of that is, say there's a cap rate of 12%. If the market goes past 12, if the market drops, wherever you are, your funds stay the same. Above 12%, the difference goes to the company. So in the case of C, you're at 100,000 and the market drops. Well, you stay there. And then the market is going to come back up 50%. So 50% of 100,000 is 50,000. So that's where your 150 is. Now your 401k, when it drops 50%, it goes to 50,000, right? So when it goes back up 50%, it's 50% of the 50,000. Half of 50,000 is 25. So you add that 25 to the 50,000, you're at 75,000. So you're at a loss. But that fits the two scenarios in which Tony was speaking about.
Yes, yes. Isn't it good to have a guru in your life? All right. Very well.
Would you like me to show them the index, Mr. Tony? I have it up.
If you have it available, I'm going to say yes. Let me stop sharing real quick.
Let me.
And you can jump in there.
Oh, okay. I think you're going to have to make me can I share?
Let me see why it should say multiple participants can share. How about now?
Okay. Okay. So this is an example of the answer D. Starting balance here is 10,000. So it drops 50%. You're at 5,000 here. So then it goes back up 100% on this 5,000, and you're back at your initial investment. Then the market increases again 100%, which is great, and you're at 20,000. But if it drops 50%, right, that's half of 20,000, you're down 10,000. So this over here shows you where you actually have a negative 25%. When we talk about the index, this is the index concept. And again, this is where you can participate with the gains of the market, but not the loss. The market is based on the S&P 500. Those are the top producing companies like the Microsoft, Google, and so forth. So an example, this blue line right here represents the S&P 500. This orange line represents the index that I was talking about, participating in the gains but not the loss. So here, if we go back to 2002, we're both starting at 100,000, this orange line and this blue line. 2002, the market dropped due to the dot-com bubble. So the S&P 500 dropped to $59,037. The index right here stayed at 100,104. The market dropped again in 2009. It dropped to 71,705. It didn't drop, it made money, but then the market dropped again. But guess what? The index stayed at 143,696. And if you go all the way up to 2016 here, You can see the market has 150,477. You made money. You made 50,000 over your initial 100,000 investment. But over here, you have 200,000 and 383,000. So in the long run, you made more money. And this is called the index strategy.
I love it. I love it. Does anybody have any questions on that? Pretty cut and dry. So if you don't mind me interjecting in there, Ms. Baylark, when I got started in census, there was a young lady that did the presentation for me. Her name was Pamela Pitcher. And you know, I worked in the oil and gas industry for over 20 years. So when I came to the meeting, a one-on-one meeting, I walked into the meeting room, and everybody was there. Tracy Weathers was up front speaking, and everybody was in there, and everybody was wearing the best outfits ever. It looked like everybody was. It's just a room full of millionaires. It was amazing. And I come in there with my lime green reflective vest on, smelling of gas, just funky. And I walked in, and you could hear the record scratch. You know, they're like slow motion turnaround. Who's this stinky guy standing in the back? But it was right then and there. I knew I was in the right place because first of all, everybody was dressed really well. And then I go back and I sit down with Pamela Pitcher, and I have a chance to sit down and talk to her. And so she shows me the presentation, the whole presentation. And the whole presentation was absolutely great. I loved it. But then she got to that screen that Miss Baylark just showed her, and I stopped her right there. I said, you could have showed me just that and saved all this time. I'm in. Because after losing all that money in 2001 and losing that money again in 2008, if someone can tell me that I don't have to lose money anymore, I'm going to be all ears wide open. So I'm excited that Ms. Baylark will share that with you all. So I'm looking forward to being able to see if you all take advantage of that, especially in the coming financial years with our new presidential situation going on. So great answers. I love it. Let's keep it going. Okay, so we have the next question. All right, I got a little motivated on this one, so I'm gonna read this one. I'm not gonna pick on you, Miss Annette. I thought about it, but I'm not gonna pick on you. I think I'll pick on you
Tony,
later.
I don't see your slide.
Can you see me now?
Your slide's not up.
Okay, let me stop
Yeah,
again.
now we can.
I turned it off, and then you can see it. That's hilarious. Okay, here we go. I've been having all kind of technical difficulties today. Can you see it? Still not
Not
seeing it?
yet. There we go. It's there
It's up?
now.
Okay,
It's
there
up
it
now?
is.
Okay, I guess it just takes a minute. Okay, so you just retired from the post office after 30 years with 250,000 in your retirement savings. The person on here, the person that this is about ain't on here, so she doesn't have to worry about being picked on. So you just retired from the post office after 30 years with 250,000 in your retirement savings, and you are only 55. You are not ready to retire and do not yet need that money. Instead, you get another job that offers a second retirement plan, but does not match your contribution. You plan to stay until you are 65 and then you retire. What do you do with the money for that first retirement plan? Leave the money in the post office plan, transfer the money into your new employer plan, roll over the money into a private individual retirement account, cash the money out, pay the taxes, and store the money in the bank. Now, I'm sure we can all agree D ain't the answer, right? But those first three are a bit tricky. So who wants to volunteer that one?
Move the money into a private individual. Number 3.
C, roll over the money into a private individual account. Okay, anybody else?
I would say C.
Okay, I got another C. Anybody else? Okay, the answer to this question is actually C, but you can actually get away, and Miss Baylark, she'll back me up on this. You can actually get away with B and A, right? Depending on the situation. And the reason why that's important, if it's more advantageous for you to leave the money in the post office, then leave the money in the post office, right? Or post office or any employer, but sometimes they don't let you leave that money in there, right? Transfer the money into your new employer if they allow it, because some people have one different place and another different place, and you can transfer that money, but there might be a cap to that. But because the new employer does not match your money, that's why I wanted to put this question in there, because if they're not matching your contributions, you might be better off rolling that money over into a private individual retirement account, and then you'll be able to better manage your money. What are your thoughts on that, Ms. Baylor?
Well, like you said, depending on the post office plan. Now, I'm not sure about the post office, but some you can't move over until you're 59 and a half. Now,
Right.
if you left the job, then you can move it over to a plan. So yes. If your employee, I agree with Mr. Tony, if your new employee is not going to match, then it's best to put it in your own plan, because when an employee matches your contribution, that means it's going to offset the taxes, because you're going to wind up paying the taxes. If you put that money into a tax advantage account, you're still going to have to pay taxes later on. But the advantage of the tax advantage account is that you're going to be accumulating money, right, through the interest crediting options. And so the interest crediting option is going to help you offset that tax responsibility. So in the long run, you're going to pay less taxes.
I love it. So the idea behind this question, I mentioned an individual retirement account. So if you put your money into an IRA, you can also put your money into an annuity, a single premium deferred annuity, right? And some of those annuities pay some pretty high premiums, especially if you're going to be leaving the money in there 7, 8, 10, 14 years, right? So again, if you're sitting down with your life insurance professional or your retirement specialist, we want to look at all the different options available to you to be able to give you the most advantageous recommendation, and then you can make the choice on which way you want to go. I mentioned the 55 to 65 not only because that's that's a good time for an annuity, but also to let you know that you don't need the money right now. So if it's money that you need right now, then you don't want to be putting that money away for 10 years if you plan on using that money for anything specific, right? So that's why I had that question. So did anybody have any questions on that question?
A question is do we reach an age where we don't have to pay taxes?
Say that one more time with the question.
Do we reach an age 70, 80, 90 where you don't have to pay taxes? Are we, as long
You
as
have to pay taxes after you die.
Yeah.
Miss Baylor, I don't think I'll
Simple
have.
no would have been sufficient.
Oh, Miss Baylor, I don't think.
Well,
I
the
can
one
handle
thing
that
about
question.
those accounts, the IRS is going to want their money. So if you have it in an account, if you're not using it by age 72, it's something that's called minimum required distribution. They're going to take it anyway. The goal is with the tax advantage account, yeah, you pay death taxes, but then you don't if planned properly. That's why you avoid that, especially if you're trying to leave a legacy, because you don't want your kids or your grandkids to pay taxes.
That's right. That's right.
On your death.
You know, and another thing about that required minimum distribution, if you wait until that time, the amount of the tax penalty is going to be substantial. What is it, 50%, Miss Baylor, they're going to take?
I'm not sure. I don't think it's that high. I'm not sure about the percentage.
Well, I know that they're going to add
but I know you do have to take, you can't go past 75. I mean, 72. That
72,
much I do know.
yeah.
So I would have to check that.
Hefty.
Yeah.
I think the total would be 50%, because I think it's an extra 10% is going to be added on top of whatever you're going to be taxed, and that's usually going to bring you up to 50%. So you can already imagine that this person has $250,000. They retire and knock another $125,000 off of that. You know, a lot of people go back to work because they don't account for the taxation when they get ready to retire. You know, they look at their accounts. I got, you know, one of my brothers, he has a little over $1 million in his retirement account. He's about my age, just 55. And it's like, hey, Tony, I got a million, $1.1 million in my account. I said, is it a qualified account? He says, yeah. I said, you have $600,000. It's the truth, because you got to pay the taxes on it. So we want to make sure you remember that you pay those taxes. It's important that you understand that if your employer is not contributing or matching to your retirement plan, that means all the tax debt and everything else, you're going to be paying that, right? Any employer that matches it, you can basically say that money wasn't yours in the first place. So when the taxes hit, you can just say your employer covered the taxes and the balance is what you saved up over the lifetime of your career with your job. So thank you, Ms. Baylor. Let's go with another one. Let's go with a juicy one, right? The one that I get probably most often. What is the best way to get money from my life cash value insurance policy? I still didn't rewrite that one. What's the best way to get money from your cash value life insurance policy? Anybody want to volunteer that one? Borrow the money from the insurance company against the face amount. The owner may make partial withdrawals after the first policy year up to the available withdrawal amount. Borrow the money from the insurance company using your accumulated cash as collateral. Which one of y'all think?
Probably.
I say B.
I'll say C.
I got a B, I got a C. Okay.
C.
I got another C. Anybody else? Okay. Miss Baylor, what's the best answer?
The best answer is C. The purpose of a policy where there's cash accumulation is that you're borrowing money from yourself. This is kind of called like be your own bank. And when you take that money for yourself, you do pay interest on it, but it's like 3%. However, the interest crediting that you're going to be getting, because while you're borrowing that money, you're still accumulating interest. So with the interest credit, it's still going to offset your interest. So it's still going to be a lot less you taking money from your cash accumulation than if you're going to take money from a bank. Now with B, when it says the owner may take a partial withdrawal after the first policy year, there's a certain limit that you have to qualify to take that out. So if you're not like over funding your cash accumulation and you don't have the required amount, then there's a surrender charge that you have to pay. And then you're going to wind up having less money. The purpose of accounts like this is actually to grow your money, right? And so when we talk to our clients and we have them accumulate, even young people, if you're going to buy a home, save that money, because, you know, down payment is what, 20%. So if you're getting interest and that money is growing and you got 40,000 in there, you can take some of that money and put it down in your home. It's your money. But the interest crediting and the interest they're going to charge you is going to offset, because banks are paying, I think the interest went down a little bit, but it was like 8 or 7%. So you're going to pay a lot less in the long run.
I love it. I love it. Ms. Baylor, another one of the questions I get from clients when they ask about getting a loan, what happens if you don't pay the loan back?
If you don't pay the loan back, when you pass on, they take it from your death benefit.
Okay. All right. So before I move on from this question, I want you all to look at one of the answers. It's going to take a second to come up, but I want you to address the answer A, Miss Baylor. Can you see it?
Mm-hmm.
Okay, so borrow the money from the insurance company against the face amount. Why is that wrong?
Well, if you borrow it from the face amount, well, it goes back to kind of like your question. If you borrow it from the face amount, you're taking it from your death benefit.
The
And then
face
I
amount.
believe,
The face
I'm,
amount, Miss Baylock, not the cash accumulation. Right? You
yeah,
can't
if you're
you,
borrowing it, yeah, I'm
you
sorry.
can't
Yeah, if you're
borrow the money
borrowing it
from
from the face amount,
you can't borrow from the face amount, right?
you borrow, you borrow from the cash accumulation.
You borrow
The
only from the
face
cash.
amount is
Yes.
death benefit.
Yes. Yes. I want
Yes,
I
the
wanted
face
that.
amount is a death benefit.
Yes. Yes. I wanted people to see the
Yes.
distinction because when you're paying your premium for a cash value life insurance policy, the portion of the premium is going to the cost of insurance, and that cost of insurance is what's paying for the face amount. That's the insurance company's money, not yours. The other portion is the cash accumulation. That's the money that you'll be borrowing against, right? So you cannot borrow
Correct.
against the face amount, you borrow against the cash accumulation. I just wanted to be able to make sure that
Yes.
distinction was made. Sweet.
Now, the one thing you can do with the death face amount, I don't know if you passed it or not, that's with the living benefits.
Yes.
Because if you did that already,
I didn't do the living benefits question yet. That's kind of like,
oh, well,
yeah.
wait.
I'm working on it. I'm working on it. This is good. You know, I try to do the whole money
I'm
management.
sorry, I'm ahead.
No, that's okay though, because if I forgot about it, I still want to talk about it. So let's go ahead and do this. Who have I not picked on? Hi, Miss Daniela. Can you see this screen? It's like, why are you picking on me?
Okay, I'm sorry. I was trying to unmute myself. Yes, I can see it.
Okay, could you read this question for me, please?
Yes, sir. It says, "What does the premium pay for in a properly funded cash value life insurance, CVLI?" Or
Absolutely. So the options are, thank you very much, Miss Daniela. The answers are most of the premium goes to the cost of insurance, as I said earlier. Very little goes to the cash accumulation. Over time, the policy could lapse as the cost of insurance rises, right? B is the premium is split near 50-50. A portion goes to the cost of insurance. The balance goes to the cash accumulation. Or C, most of the premium goes to grow the accumulating cash. A lesser amount covers the cost of insurance. The policy can be paid up at retirement. So this is a trick question. It's a trick question. So what does the premium pay for in a properly funded cash value life insurance policy? Now, I don't know if I had a chance to talk about this one because, you know, sometimes I write stuff kind of weird. So I think Miss Baylark knows the answer to this one, but I want to make sure I pick on everybody on this. Anybody want to volunteer an answer?
B, the premium is split 50-50.
Okay. Anybody else? I'm going to have to explain this one. The answer is B, and I'm going to tell you why. The answer A, the policy is underfunded. The
Right.
answer C, the policy is overfunded. Answer B is what you usually get for a properly funded IUL. I had to do it, Miss Baylar, because I thought it was fun. Do you have any comments on it? You're on mute, ma'am.
Tracy had her hand raised.
Life
Did you just-
insurance.
This is what Mr.
types,
Tony talking about. It's the combination when you make your premium.
or
Are you sharing your
cost of
screen?
insurance,
Cost of insurance.
There you go.
You can't see it?
I can see it now.
tax relief.
I can see it.
Yeah, so when you're paying your premium, you're paying the cost of insurance. Now, for young people, the best time to get insurance is while you're young because the cost of insurance is cheaper and you can grow money a little bit faster. The other cost is in the cash accumulation. And so when they're putting up a plan for you, you want to make sure you're covering the cost of insurance, but you want to do something what they call overfunding. So you want to make sure you're funding enough to pay for the cost of insurance because the more overfunding you do, the more money you're going to grow and the faster your money is going to grow. And then, of course, you have the free tax benefit that's within that policy.
I love it. She's the best.
Okay.
She's the best backup ever you can have. She's got all the slides. You gotta you gotta love it, right? Okay, stop sharing your screen. Let me see if I can bring up the presentation again. All right, here we go. So that's good stuff. So let me go to the next one. All right,
Tony,
can you hear me? I can hear
I
you.
think Tracy had a question.
Oh, I'm sorry. Let me go back. Yes, Miss Nails.
Yes, I just wanted to clarify in your slides, you're mentioning properly funded. I don't know if this is a good time. I'm not really sure what you mean by properly funded.
Share what you mean by properly funded. That means if you look at answer A, over time the policy could lapse as the cost of insurance rises. So if you have a properly funded policy, you don't have to worry about the policy lapsing. So we'll be able to get a chance. If all of you have life insurance policies, cash value life insurance policies, there's a minimum payment that you must pay to make sure your policy does not lapse. As long as you are making that minimum payment, they promise that your policy will not lapse. Now, because of the policies that we offer, they have a flexible premium schedule. There might be a day where you can pay a little bit more, knock yourself out. It just goes more to your cash accumulation. But there might be a time, like Christmas, when you might have a slight financial hardship for a couple of months. And if that's true, you can contact your agent or you can contact the financial institution and have them lower your payment to the minimum for a few months, right? But you have to remember to raise that payment back up, because if you leave that payment at the minimum, as you age and the cost of insurance increases, the cost of insurance could exceed the premium that you're paying. And if that happens, then your policy could lapse. So you want to make sure that it's properly funded. So the premium, if you keep that premium that as it was initially set up, depending on how long you live, like if you live to be 135, chances are the premium is going to be pretty high. It's true, right? But you're not going to be paying premiums to you 135. But you want to be able to make sure that the accumulating cash can cover the cost of insurance as you age, because there might be a time, say you turn 80, you no longer have an
No,
income.
babe, hold on.
You turn 80, you no longer have an income. You don't want to be paying life insurance premiums until you're 100, right? So while you're having an income, the amount of money that you're putting into that policy, when you no longer are making premium payments, the actual cost of insurance will be deducted from your cash value. So the more cash value you have available, the more your insurance company will be protected from any kind of lapse. And you still have some money left over for your retirement, be able to borrow against it, do whatever you want to do with it. So great question though. All right, let's see this one. I had fun with this one. Miss Baylark, I didn't talk to you about this question. So if I got this wrong, correct me, because I'm not perfect. Okay, I'm not perfect. Who am I gonna pick on this one? Let me see. I'm not good. I want Cassandra to do it. Cassandra, could you read this question, please?
College funding. Your child is 14 years old and wants to go to college in 4 years. You have not started saving. Which option offers the best financial flexibility? You want me to read the
Yeah, go ahead. You
okay.
sound really good.
A529 college saving plans, 4 years maturity. B, student loan, graduate with debt. C, work overtime for 4 years if you can get it. D, get the student loan, pay off with CVLI after completion, 8+ years maturity. Or E, take out a loan from your bank, credit union, higher interest.
Okay. What do you guys think of the answer? Is the proper answer for that one?
A.
I got A. Okay. Anybody else? I see Miss Annette either eating or talking. Which one is it? Okay. We got
I
an.
say,
What was your
I
question?
say D.
You say D? Okay, anyone else?
Yes.
D.
I got A, I got
D.
D, and what else? Who else?
And D.
I got another D. ADD. That's funny. Sometimes I do have it. Yeah. Anyone else? All right, Miss Baylark, what do you think the answer is?
Well, D is the best answer, but A, for a 529 college plan, you can do that. The only thing about the 529 college plan is it has to be used for college.
Right.
So say your young adult don't want to go to college. They want to open up their own business. Then you would want to use D, the cash value life insurance, because you can take that out. And actually, if you take the student loan out while you're in school, you're not paying, right? And then even when you're finished school, you're in forbearance for a while. So while you're accumulating in that cash value life insurance, then by the time they're finished, you can take that money out from your cash value life insurance and pay off your student loan debt and be debt free.
So I'm gonna tell y'all a little secret, right? This is how you know I know what I'm talking about because I didn't consult her with this question. How about that? I love it. That's absolutely right. You know, I had a client call me a couple of months ago. Her child was 16, right? She hadn't made any savings payments for her child, and she was really concerned. I was like, well, does your child want to go to college? And she said, yeah, he's desperate to go. I said, how much money can you afford to pay for his college tuition? So she gives me a number that she can pay for the college tuition. All right. So if you were to put that money into your IUL and go ahead and get the FAFSA, right? You can be getting the student loan. They can go to he goes to college in 2 years. You're paying for the life insurance policy, right? You're putting money into the life insurance policy for that 2 years. He goes to college for 4 years for a bachelor's degree. He goes to college for another 2 years for a master's degree. Now the policy's been in there for 8 years getting those payments, right? And just like Ms. Baylark mentioned, it goes to forbearance for however long. So you could actually be making, instead of having 2 years because your child is 16, you can actually have as much as 10 years paying into their life insurance policy, stacking up your cash accumulation. And when your son graduates from college with a graduate degree, graduates tax free because you go ahead and knock out that student loan payment. How about that? Right? And he still, because you still are making the payments to the life insurance policy, he still has a life insurance policy with living benefits that you can continue to make payments on and use that as a supplemental income for your retirement. Can't beat that with a bat. I love this kind of stuff. Don't I hope y'all are just excited as I
And
am.
also, Mr. Tony,
Tell me.
you don't have to list in because when you get the FAFSA, you got to list all your financial information. Life insurance, you do not have to list it for the FAFSA.
I didn't even think to say that. Every one of y'all should have a money coach. That's a little hint. All right, here
Financial
we
aid, right?
financial aid. So, Miss Baylor, help me out with this one. A loved one was diagnosed with curable cancer. The treatment is $100,000, and care plus recovery another $250,000. So $350,000 total. I didn't capitalize the Y. I'm sorry for the grammar problem. Your loved one only has $100,000 saved. What can be done to prevent financial ruin? I think I'm gonna go quiet on this one, and I'm gonna let Miss Baylard manage this one because I think she has the best information. She's got some really, really great stories about this. Miss Baylard, can you go ahead and take it for me?
Yeah, I was just reading your question.
Okay.
Okay, well, we don't want the GoFundMe.
No, we do not.
Because GoFundMe, although you're going to be raising money, you're going to pay the administrative fee. And the unfortunate thing, people aren't raising enough money for GoFundMe nowadays, because, everything is high and people are kind of like tight holding onto their money. So one of the things that we try to do and what you should do early is put proper protection in place. And that's one of the things that we really focus on, especially in the Black and Brown community. We're not doing that. So if you put proper protection in place, and we've been talking about those life policies with the accumulation that has the living benefits, the 3 living benefits, critical, if you have cancer, stroke, heart attack, renal failure, blindness due to diabetes, tumors, loss of a limb, you can use that. If you have chronic, and you can't do 2 of the daily living activities like feed yourself, dress yourself, walk. That's under like Alzheimer's, Parkinson's disease, MLS, and of course, terminal cancer. And so what that is when we talk about the death benefit that we talked about before, if you get sick, you can use a portion of that death benefit and use it to offset your expenses. Now, the key here is to put something in place before you get sick, because once you get sick, you're uninsurable. So when we talk about putting proper protection, we're talking about life insurance protection. We're talking about part of the whole thing with the cash value, with the living benefits. Now, the one thing about the living benefits is you don't have to pay that back. But what happens is that when you pass on, whatever monies is left, and they will always leave enough money for you to leave a legacy. So whatever is that death benefit, and you use it to offset your expenses, because we're living longer, right? So with a policy with the living benefits, you can use for yourself. You no longer have to die, and your family or your friends or whomever uses all your money. You can use your own money. You can be your own beneficiary on the policy using the living, well, not your own beneficiary, but using the living benefits, you're able to use the money. So, yes, so that's the proper protection that we put in place. When Mr. Tony was talking about the stories, one of the stories I always use is my brother, because people look at life insurance as an expense, and it's not. It really is a necessity. And although we live from paycheck to paycheck, most of us, the most important asset we have is the ability to generate income. So if you get sick and that income isn't coming in, what are you going to do? Right? And most people, if they have a home, they got to go into their equity in their home, or they go into their retirement. Setting something up with the living benefits, if you should get sick, protects you from that, meaning you can keep your assets. My brother got his policy. He didn't have it 6 months before he was diagnosed with prostate cancer. And he too was like a lot of people. Oh, I can't afford it. You know, things are tight right now. And I had to tell him, well, what if you get sick and you don't have money coming in? What are you going to do then? You know? And so he took my advice, and he only did it, I'm sure, because I was a sister, but it was the best advice it was the best thing I could do for him, because 6 months later he was diagnosed. He did get the money, and there's money left for him to leave a legacy for his son. So the living benefit is a very, very powerful tool. And the living benefits in a policy is a little bit more expensive, but you get more. But the key is to put something in place so that it's not a strain on your family. I'm a church administrator. I'm here still at the office. So I'm a church administrator, and I can't tell you how many times families have come up to the church asking for money because they didn't have anything in place. Something simple has final expense to put in place to cover all those expenses. You can't do, the living benefits, at least put a final expense in place. But the living benefit is there to protect your assets.
All right. That right there is, when Miss Baylor, she does that presentation, she talks about her husband. My mother, she died of end-stage
Brother.
Brother, I said brother. I'm sorry, I thought I said brother, but I shifted over to my mom. So my mother, she passed last year from end-stage renal failure. And one of the main reason why I wanted to do this kind of like training class, this type of training class, is because my uncle just died in June, and he had accidental death and dismemberment policy, right? He got that policy back in 2007. His wife, he and his wife got married a couple of years ago, and he just swore before God that that policy was going to take care of his wife if he were to expire. He died on June 18th cooking bacon in his kitchen of a heart attack. That was not an accident. So she comes home and sees her husband laying on the kitchen floor. She calls me then the next morning asking about the life insurance policy. And the hardest thing that I've done since I've been in this business is sit across the table from someone and tell them that that policy is not going to protect them financially, because he did not die from an accident. He died of natural causes. So it's essential that, I hope you all have been taking notes. We only have one more question after this, but I wanted to be able to say this. It's essential, if you have a life insurance policy right now, that you know what you have. And if you don't have a life insurance policy, then you need to, sit down and talk with, it doesn't have to be us, but you need to sit down and talk to a professional that can help you figure out what it is that you need for yourself and your family and your family's legacy. Because again, like Ms. Baylark said, you want to do it while you're healthy, because after the fact is always too late. So I'm going to go ahead and share my screen, because I want to pick on a couple of ladies on this line with this next question. I think you'll appreciate it. All right, so I'm going to read this one, and this is actually a question that I got from. She's not online right now. I wanted to pick on her, but she didn't get a chance to jump on her. So imagine someone who has a big old huge chunk of money in a checking account, and they're losing money hand over fist through inflation, right? So I kind of parodied this question off of her financial situation. So you're turning 67 and plan to retire in 3 months. You're 67 and plan to retire in 3 months. You save $778,912 in your 401k that you cannot leave in your employer's planned accounts. So you have to take the money out when you leave, right? You will be collecting Social Security, but you will need the 401k to supplement your income. Which option would stretch your savings longer? Now, before you answer this, remember, you cannot leave it with the employer, and you need the money now. So an IRA might not be the option, because you're not going to be contributing. You need to start taking the money out. So you have to put your money in a financial institution where you can get those payments. So which one has the best answer? And I need to move the screen because it's in the way of the answers right now. So I got to put y'all to the left. Remember the rule of 72. Anybody that's been on before knows what that is. Rule of 72 means you divide whatever interest rates you're getting by into 72. That'll let you know how long it takes for your money to double. So 72 divided by 2 is 36 years. That's too long. So you want to make sure that you put your money into a financial institution that's going to give you that better than that 2% that you're getting from a bank. So again, which option would stretch your savings longer? You roll over the balance into a single premium immediate annuity and receive tax payments. Liquidate the funds and store in a savings account. Liquidate the balance and reinvest it into the stock market. Liquidate the balance, place a portion in the bank for your emergency fund, and invest the balance in certificates of deposit. So which option would stretch your savings longer is the question. Again, it's the final exam question. Whoever gets this right gets mad kudos from Ms. Baylark. Roll over the balance into a single premium immediate annuity and receive tax payments. Liquidate the funds and store in a savings account. Liquidate the balance and reinvest into the stock market. Liquidate the balance and place the portion into the bank for your emergency fund and invest the balance in certificates of deposit. Who wants to volunteer that answer? Yes, it's hard on purpose. What'd you say, Miss Royalty?
I said Daniela said D.
Daniela said D. Liquidate the balance, place a portion in the bank and for your emergency fund, and invest the balance in your certificate of deposit. Okay, we got D. Who else?
C.
I heard what? Another D?
C.
Okay, I got a C in there. Anyone else?
I'm teetering between A and D.
You're teetering between A and D.
Yeah.
Oh, I should have. Miss Baylock, I should have led with this one, huh? I should have led with this one. Okay, we got a D, a C, and a D. No one says B. Liquidate the funds and store in a savings account. So we know the savings account ain't the place to put the money. That's good.
And
That's a
said
step in the right
between
direction.
A and B, Tony.
You
Miss
got
Annette said between A and B.
between A and B or
No,
A and
I
D?
said A and D. D is in
Oh,
dog.
A and D for dog. Okay.
Oh
So no one said
boy.
B.
Oh boy. Rock, paper, scissors. Okay,
There
right.
are people putting their answers in the chat. So
Oh,
don't
I
know if you
can't see it.
that.
That's why. Let me see what we got here. Let me stop sharing. And oh, that's a juicy one right there. Okay, okay, I'm way behind. There's a whole lot of conversation in this chat room. I didn't see all that. Why y'all tell me? Okay, A and C, D, A, D, A. Okay, okay. Let me bring the question back up one more time. Okay, this is the. Oh man, I'm over. I'm sorry. It's already 6 o'clock. Let me hurry up. Okay, so let's go ahead. Which option would stretch your
9 o'clock.
my bad. 9 o'clock for you East Coasters, and it's 8 o'clock for you Central Time. So I'm gonna hurry up and shut up. Okay, so I'm gonna go with B being completely and absolutely unequivocally wrong. Why would you take your money and put it into a savings account? So let's knock that out. Liquidate the balance and reinvest it in the stock market. If you reinvest your savings in the stock market and you're trying to retire, you stand a chance of losing that money. That would not be the great option. Answer D is actually exactly what my client did. Exactly. Liquidate the balance, place a portion in the bank for emergency fund, and invest the balance in the certificates of deposit. Even though that's exactly what she did, Miss Baylark, is that right?
No, because actually those CD products are a part of the market. So when she took that money out and she put it in a CD, number one, it's in the market, so she's going to lose. And number two, a CD, the rate of return is like 3 and 4 when she could have placed it in A and got a better rate of return with her money.
Absolutely. And a certificate of deposit is also taxable income.
Yes.
Yeah, so your money you'll literally be taxed twice if you do that. So again, Ms. Baylor, to her point, you put your money into a single premium immediate annuity. The money that you're not losing is going to be earning a higher interest rate than what you're going to be getting in the bank. And because it's a protected product, you don't have to worry about suffering any market losses. So how about that? I'm sorry I went over a couple of minutes, but you know what? I had a good time with that. I hope everybody learned something. Anybody have any questions? Let me see who we got in here. Daniela, Joyce, iPhone, Galaxy, Annette, Devon, Pastor Jay. I know you don't have any questions, Miss Baylard. Tracy, Miss Royalty, that Tony Warfield guy. Does anybody have any questions?
Who is Galaxy S21 and I?
Galaxy
There's
S. Who that is? I don't know who Galaxy S21 is.
Please identify yourself.
Please identify yourself.
Who invited you, as well as iPhone?
iPhone and Galaxy S21. Okay, they might have put it in the chat.
Don't know how to mute.
Did I put them to sleep?
Oh, they might don't know how to come off mute.
They might not. Yeah, let me see. iPhone to everyone.
They're on mute.
Yeah, let me see if I can send them an ask to unmute and an ask to unmute. There you go. Miss Galaxy, Mr. or Mrs. Galaxy S21 and iPhone. That the iPhone is off mute. So iPhone, what is your name, please?
Hi, it's Jacqueline. I'm off mute.
Gotcha. Hi, Jacqueline.
Hi. I just been listening in the background.
That's right. I hope you're getting educated. Okay, what about Galaxy S21 5G? Okay, I'm sure they'll let us know eventually. So that's it for the presentation tonight. Thank you all so much for your interaction and some of your answers. I hope you learned something. Miss Annette, I'm gonna be picking on you.
She's off now.
Who's off?
She's unmuted.
Okay, got it. Okay.
Galaxy.
She's off. Okay, no problem. They didn't want to say hi. It happens, So right now, all our
Hi.
guests, if you don't have any
He said
questions,
hi.
she said hi.
Huh?
Hi, Galaxy
She said,
S21. What's your name?
Lucille.
I knew it.
Oh, I love the name. You know, as soon as
Is
you
that
said
Miss
Lucille, I thought
Lucille?
about the guitar.
Yes.
I did.
Hey,
Hi.
Miss Lucille.
Miss Lucille, did you have any questions, my friend?
No, I don't. I was just listening.
Okay, all right. So that does conclude the test. Thank you all so much. We made it through. I hope you enjoyed it. I hope the questions helped you out. I hope the conversation helped you out. Miss Baylark, as always, you are phenomenal. Because sometimes I don't remember some of the stuff to ask or tell, but she knows everything, right? She knows that's why she's the resident guru, right? Do you see the sprockets going in her head? They're just firing off left and right. I love it. So we do this. We're going to be meeting. We're probably not going to. I don't know if we're meeting next week, but we'll see what happens. But this weekend, if you are in the Los Angeles County area, Miss Baylor, do you have the United BPM flyer available?
I don't have it downloaded on my laptop.
Okay, so everybody that's in the Los Angeles County area, I think I know everybody here. I'll make sure you'll get that flyer so you can join us this Saturday. Everyone who is not in the Los Angeles County area, because it's not going to be on Zoom, I'll think of you lovingly while we're out there. So everybody on the team, please stay on. If you are a guest, I welcome you and invite you to enjoy the rest of your evening. And thank you so much for your time. I'm gonna go ahead and stop.